So when we say bonds payable, it refers to a formal and conditional promise made under seal to pay a specified amount of money at a determinable future date to make periodic interest payment at a stated rate until the principal sum is paid. So the parties involved include first the bond issuer. It is the entity such as a corporation or government that issues bonds to raise funds. So the issuer borrows money from investors by selling bonds and promises to repay the principal amount at maturity along with periodic interest payments. So the second one is bondholder, the investor or the lender. It is an individual or an entity that owns a bond issued by a corporation or government. So by purchasing the bondholders becomes the creditor to the issuer and is entitled to receive periodic interest payments from the issuer until the bond matures. So the last is the underwriter or arranger. It is an individual or financial institution that helps facilitates the issuance of securities such as stocks or bonds, and on behalf of a company or a government entity. In simple terms, the arranger or underwriter, it is a middleman between the bond issuer and the bondholder, which they get a fee from borrower or gain on reselling instruments. So next is the recognition. So the recognition of bonds payable, it is when the entity becomes a party to the contract or when the transfer of resources transpired. The next presentation. So the bonds payable is presented in the liability section, the statement of financial position, and classified as either current or non-current depending on the expected settlement date. So the next is the initial measurement of bonds payable. So bonds payable classified as financial liabilities at amortized cost shall be initially measured at fair value minus transaction cost. And this fair value is determined through in order. First is the quotation from an active market, and second one is the present value of all principal and interest payments. So the transaction cost incurred at financial liabilities at amortized cost. These transaction costs or bonds issuance costs directly attributable to the issuance of bonds payable is treated as an adjustment to the premium or deducted from or discount added to on bonds payable and not treated as an outright expense. So it is different from the financial liability at fair value through profit or loss because in there, the transaction cost or the bond issuance cost is treated as an outright expense. However, in the financial liabilities at amortized cost, it is treated as an adjustment to the premium or deducted from or discount added to on the bonds payable. So, its subsequent measurement, the bonds payable are subsequently measured at amortized costs using the effective interest method of amortization. So, there are different schemes in the issuance of bonds. So, first, when bonds are issued at face amount, the proceeds is equal to the face amount, the effective rate is equal to the nominal rate, and the maturity value is at face amount. So, when bonds are issued at a premium, it is said that the bonds are sold at an amount higher than the amount being borrowed, hence the proceeds is greater than the face amount, the effective rate is less than the nominal rate, and the maturity value is at face amount. So when bonds are issued at a discount, it is said that the bonds are sold with the amount lower than being borrowed, so hence the proceeds is less than the face amount, the effective rate is greater than the nominal rate, and the maturity value is at face amount. So the presentation of bonds payable, so the net carrying value is to be reported in the face of the statement of financial position as part of the current or non-current section. So first, when bonds issued at face amount, so its net carrying value is face amount. And bonds issued at a discount, so the face amount, we deduct the discount on bonds and we get the net carrying amount. And last is bonds issued at a premium, we have the face amount, we add the premium on bonds, there we get a net carrying value. So to fully understand the concept of bonds payable, I have here illustration. We have the issuance of bonds at premium on interest dates. So the problem is Sibugay Corporation is authorized to issue 1 million of 5-year bonds dated June 30, 2021 with a stated interest rate of 10%. Interest on the bonds is payable semi-annually on June 30 and December 31. So the company uses the effective interest method. The bonds were sold to yield 8%. So we are required to determine the following. First is the bond issue price. The second is the interest expense for 2021 and 2022. And the third is a carrying value of the bonds on December 31, 2021 and 2022. And last, we are required to prepare the necessary journal entries. So first is we're going to compute the bond's issue price. So since the interest is payable semi-annually, the present value factor should be determined using semi-annual interest at 10 semi-annual periods. So that is a 5-year times 2. So we have here present value of principal, which is equals to 1 million. So times, we're going to compute for the PV of 4 for 10 periods. So we have here 1.04 for 10 periods. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we get 0.6756. So this is equals to 1 million times 0.6756. So we have 675,600. So for the PV of interest, so we have 1M times 5% interest. It is because it's semi-annually. So 10 divides 2, which is 5, times the PV annuity of 1. So we have here 1.04. For 10 periods, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Minus 1 divides 0.4. So we have here 8.1109. So we have here 1 million times the interest rate 5% times 8.1109. So we get 405,545. So the total issue price so we simply add this 600 plus 405,545. We get 1,081,145. So this is now the issue price. So the second is interest expense for 2021. So to compute for interest expense for 2021, simply we have here the present value, computed present value of 1,081,145. We just multiply it by the rate, which is effective rate rather 0.4. We get interest expense for 2021 is 43,246. So for the interest expense for 2022, so we can see it in the amortization table. So we have in June 30 rather 2022, we have an interest expense of 42,976, and on December 31, 2022 is equal to 42,695. So our interest expense for 2022 rather, is equals to 42,976 plus 42,695. We get 85,671. So next is the carrying value of bonds on December 31, 2021 and on 2022. So the carrying amount on December 31, 2021 is equal to 1,074,391. And the carrying amount of bonds on December 31, 2022 is equal to 1,066,1. So we can see this in the amortization table. So for the last, we have to prepare the necessary journal entry. So our first journal entry is to record the issuance of the bonds on June 30, 2021. So we debit cash which is equal to 1,081,145. We credit bonds payable at face amount 1 million, and then credit also premium on bonds payable is equal to 81,145. And then our second journal entry is to record the interest expense. So we debit interest expense is equal to 50, and then cash is 50. And then the third one is to record the premium amortization on December 31, 2021. So we have premium on bonds payable 6,754, and interest expense is equal to 6,754. So for the presentation, in the presentation with regards to the statement of financial position, so the bonds payable with the amount of 1,074,391. And for the statement of comprehensive income, the interest expense of 43,246. And last, the notes to financial statements, we have bonds payable amounting to 1 million. We add the premium of 74,391. We get the carrying amount of 1,074,391. The issuance of bonds at discount on interest date. So the problem is Sibugay Corporation is authorized to issue 1 million of 5-year bonds dated June 30, 2021 with a stated interest rate of 10%. Interest on the bonds is payable semi-annually on June 30 and December 31. The company uses the effective interest method. The bonds were sold to yield 12%. So we are required to compute the bond issue price, the interest expense for 2021 and 2022, the carrying value of the bonds on December 31, 2021 and 2022, and last, to prepare the necessary journal entries. So first, we're going to compute the bond issue price. So since the interest is payable semi-annually, the present value factor should be determined using semi-annually interest at 10 semi-annual periods, that is 5 years times 2. So we have here present value of principal, which is equal to 1 million times using the effective rate, which is 6%, so 1.06. For 10 periods, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we get 0.5584. So 1 million times 0.5584. So we have here 558,400. Then the PV of interest, we have here 1 million times the rate, interest rate, which is 5%, times the PV annuity of 1. So we have 1.06. So for 10 periods, 2, 3, 4, 5, 6, 7, 8, 9, 10, minus 1 divides 0.06. So we have here 7.3601. So 1 million times 5% times 7.3601. So we have here 368,005. So the total issue price is equal to, we just simply add this 558,400 plus 368,005. So we get 926,405. So the second one is interest expense for 2021 and 2022. So interest expense for 2021, so to compute this, we just simply multiply the interest rate to the total issue price. We have 926,405 times the effective rate, which is 0.06. So we get for the interest expense for 2021 is equals to 55,584. And then interest expense for 2022. So we can see this in the amortization table. So interest expense as of June 30, 2022 is equal to 55,919, and for December 31, 2022 is equal to 56,275. So we get interest expense for 2022 is equal to 55,919 plus 56,275. We have here 112,194. So next is the carrying amount of the bonds on December 31, 2021 and 2022. So the carrying amount for 2021 so is equal to 931,989. And the carrying amount for 2022 is equal to 944,183. So we can see this in the amortization table. So last is the journal entries. So our first journal entry is the issuance of bonds. We have cash is equal to 926,405, and discount on bonds payable is equal to 73,595, and bonds payable at face amount is equal to 1 million. And our second journal entry is to record the interest payment of December 31, 2021. So we have interest expense equal to 50,000 and cash 50,000. So last is to record premium amortization on December 31, 2021. So we have here interest expense and then discount on bonds payable. So is equal to 5,584 and 5,584. I have very important notes to effective interest method. So when bonds are issued at a premium, its carrying value is declining, its interest expense is also declining, and its amortization is increasing. And when bonds were issued at a discount, its carrying value is increasing, its interest expense is also increasing, and its amortization is also increasing. So let's move on to the recognition of bonds payable. So a financial liability should be removed from the statement of financial position or the balance sheet when and only when it is extinguished, that is when the obligation specified in the contract is either discharged, cancelled, or expired. So the retirement of non-convertible bonds payable. So retirement of bonds prior to date of maturity, we have two: retirement price applicable to principal and the carrying amount of bonds on the date of maturity. And we have the difference is recognized as gain or loss on extinguishment of bonds, part of profit or loss for the period. And when the retirement of bonds prior to date of maturity, we have the settlement price and carrying amount will be equal to the face amount and no gain or loss is recognized. To understand this concept, I have here illustration on retirement of bonds. So the Globan Corporation is authorized to issue 1 million of 5-year bonds dated on June 30, 2020 with stated interest rate of 10%. Interest on the bonds is payable semi-annually on June 30 and December 31. The company uses the effective interest method. The bonds were sold to yield 8%. So we are required to determine the amount of gain or loss assuming the bonds were retired under the following independent situations. So first is on January 1, 2021 at face amount, and 2 on April 1, 2023 at 105, and 3 on June 30, 2025. So first we're going to compute the gain or loss on retirement of bonds on January 1, 2021 at face amount. So we have here retirement price 1 million less the carrying amount. So this carrying amount, we can see this in the amortization table. We have here 0.7, 1,074,391. So we have here the gain on retirement of bonds to be recognized in profit and loss. So this equal to 74,391. So the second requirement is the gain or loss on April 1, 2023 at 105. So we have here retirement price is equal to 1 million times 105%. So this equal to 1 million times 105% is equal to 1,050,000. Then we less the carrying amount. We can see this in the amortization table. Carrying amount for December 31, 2022, which is equal to 1,044,562. Less for the amortization up to 041. So to compute, we have 8218 times 3 divides 6. So we get less 4109. So 1,044,562 minus 4109. So less 1,040,453. So the loss on retirement of bonds recognized in P&L is equal to 0.50 1,050,000 minus 1,040,453 is equal to 9,547. So for number 3 is on June 30, 2025. So it is 0 because on June 30, 2025 maturity date, the retirement price and the carrying amount is equal to the face amount of the bonds. Thus, no gain or loss shall be recognized. So that's all for my part. Thank you for listening.
Good day, everyone. This is Malka, and for today, I will continue discussing Chapter 7 Financial Liabilities and Debt Restructuring. First, let us talk about what is compound financial instruments. So, compound financial instruments are financial instruments that incorporate both a liability and an equity component from the issuer's perspective. Examples of compound financial instruments include convertible bonds and debt instruments issued with detachable share purchase warrants. So, what do we mean by convertible bonds and debt instruments issued with detachable share purchase warrants? So, convertible bonds allow bondholders to convert their bonds into a predetermined number of the issuer's common shares at their discretion. Initially functioning as debt securities, convertible bonds provide interest payments and repayment of principal, but also offer the option for bondholders to convert them into equity shares. Similarly, debt instruments issued with detachable share purchase warrants start as debt obligations, entitling holders to interest payments and repayment of principal, while also providing detachable warrants allowing the purchase of additional shares at a specified price within a defined period. These instruments blend features of debt and equity securities, enabling issuers to raise capital while offering investors the potential for future equity participation. The accounting treatment of compound financial instruments is through split accounting. So split accounting, as mandated by PAS 32, requires the separate presentation and accounting for the component parts of compound financial instruments based on their substance as liabilities or equity. The approach to splitting involves allocating the initial carrying amount of the instrument to its equity and liability components. This is typically done using the residual approach, where the equity component is assigned the residual amount after deducting the fair value of the liability component from the fair value of the instrument as a whole. This split occurs at the issuance of the instrument and remains unchanged despite subsequent changes in market conditions. The goal is to accurately reflect the true nature of the instrument's components and ensure transparent financial reporting. Bonds payable with detachable warrants. When bonds are issued with detachable warrants, the warrants grant the bondholder the right to acquire equity securities of the issuer at a predetermined subscription price. This entitlement to equity securities alongside the bonds implies that the entity has effectively issued both debt and equity instruments. Therefore, when allocating the total proceeds from the issuance, the residual approach is used. This approach involves assigning the remaining amount after deducting the fair value of the bonds from the total proceeds to the warrants. By employing the residual approach, the issuance proceeds are accurately allocated between the bonds and warrants, reflecting the dual nature of the financial instrument. So, the formula para makuha nato ang appropriate allocation sa warrant is performed as follows. So, total proceeds, which is ang asset, imo sadyang minusan sa fair value of the bonds payable, mao na sadya ang liabilities, and then ang ilang difference is mao na sadya ang value assigned to warrants or ang equity. So, mo na ni siya gitawag og split accounting, wherein ang equity component is atong gi-assign, or the equity component is assigned the residual amount after na to i-deduct ang fair value of the instrument. So, let's analyze the illustration on bonds payable with warrants. So, Ormo Company issued bonds payable with warrants of 4,000, 10% 5-year bonds, face value of 1,000 pesos at 98 on January 1, 2021. Each bond is accompanied by warrant that permits the bondholder to purchase 20 shares of common stock or 50 pesos at 55 pesos per share. The nominal rate is payable annually on December 31. The bonds mature on December 31, 2025. When the bonds are issued, the prevailing market rate of interest for similar bonds without warrants is 12% per annum. So there are 5 requirements, and let us first discuss the first requirement, which is amount allocated to warrants. So please, pagtanan na lang sa libro para makasubaybay mo sa computation. So ato lang gamiton dire ang formula para i-allocate nato, or the appropriate allocation sa assigned warrants. So first is ato sang computon kung pila ang total proceeds or pila ang total na asset. So di ba naka-state dire sa problem na ang Ormo Company is ning issued siya og bonds payable with warrants of 4,000 and nas jay face value of 1,000 at 98 pagka January 1, 2021. So ang 4,000 is ato siyang i-times sa 1,000. So na nakabutang dira 4 million, then ato siyang times sa 98% kay with face value man kuno of 1,000 at 98. So 4 million or 4,000 times 1,000 is equal to 4 million times 98%. So ang atong total proceeds or ang atong total asset is 3,920,000. And then ato siyang lesson sa fair value of bonds without warrants. So ato sang pangitaon ang present value of principal payments and present value of interest payments. So daring dapita is magamit na ta sa formula sa atong PV of 1 and PV of OA1. So ato sang kumputon ang present value of principal payments. So di ba naatay 4 million nga warrants, kay di ba 4,000 man, then na yung face value nga 1,000, so 4 million times 0.5674. So para makuha nato ang 0.5674, mo gamit ta og PV of 1. So PV of 1 is equal to 1 over 1 plus r raised to n. So atong gamitan og katang steps bitaw para dali ra sa ma-compute sa calcu. So ang atong r dere is 12% per annum, kay mo ni siya ang prevailing market rate of interest for similar bonds sa kadtong mga without warrants. And then ang atong n dere is 5-year bonds, kay ang bonds payable is nakastate there sa problem is 10% 5-year bonds. So ang atong n is 5-year. So kanang ato i-plus ang katong interest 12%. So 1 plus 12% is equal to 1.12. So 1 divide by 1.12 and then imong pinduton ang equal kalima. 1, 2, 3, 4, 5. So ang atong i-time sa 4 million is 0.5674. So 4 million times 0.5674 is equal to 2,269,600. So, mo na ang atong present value of principal payments. The next atong kuhaon is ang present value of interest payments. So, nikuha na to sa present value of interest payments is ato siyang gamitan og PV of OA1. So, 4 million times 10% kay naka-statement dire sa problem nga naay interest dire sa bonds payable nga 10% times sa kadtong makuha nimo sa PV of OA1. So, ato nang computon ang PV of OA1. So, PV of OA1 is equal to 1 minus sa PV of 1 over R. So, 1 minus ang atong PV of 1 ganinang nakuha is 0.5674. So, may equal sa dya og 0.4326 and then ato sa dyang i-divide sa interest which is 12%. So, mo equal sa dya og 3.605 or 3.6048. And 4 million times 10% times 3.6048 is equal to 1,441,920. Mo is the present value of interest payments. So, 'di ba ang sa formula nga atong nakita ganina inikuha sa value assigned to warrants, ang total asset or ang total proceeds is ato silang i-minus sa fair value of bonds without warrants. So, ang 3,920,000 is ato silang i-minus sa sum sa present value of principal payments and sa present value of interest payments. So, ang sum sa present value of principal payments o sa interest payments is na si Jai 3,711,520. So, ato nang i-minus 3,920,000 nga proceeds atong i-minus sa fair value of bonds without warrants nga 3,711,520 is equal to 208,480 pesos. So, mo ni si Jai amount allocated to warrants. So, next is requirement number 2. So, ang requirement number 2 is interest expense in 2021. So, para makuha na to ang interest expense sa 2021, kinahanglan ta maghimo og amortization table for the bonds payable. So, kining babaw mo ni sadya ang amortization table na ay date, na interest payment, interest expense, discount amortization, and ang carrying value. So, para makuha na to ang interest payment, ang 4 million is ato sadyang i-time sa 10%. So, 4 million times 10% is equal to 400,000. So, ang atong carrying value is 3,711,520. So, mo ni siya ang fair value of bonds nga katong without warrants. So, ang carrying value nga 3,711,520 is ato siya i-time sa nato siya sa 12% nga interest rate sa katong mga without warrants. So, mo na siya interest expense nato December 31, 2021. So, we have 445,382. So, para makuha na to ang discount amortization, ang 400, ang interest payment is ato sadyang i-minus sa interest expense. So, 400,000 minus 445,382 is equal to 45,382. So, muna sadyang atong discount amortization sa December 31, 2021. And para makuha na po nato ang carrying value sa December 31, 2021, ang carrying value sa pagka-January is ato sadyang i-add sa discount amortization sa December 31, 2021. So, 3,711,520 plus 45,382 is equal to 3,756,902. And mo na sadya ang computation or solution sa uban pa dira nga date like sa December 31, 2022, 2023, 2024, and 2025. So, ang atong interest expense sa pagka 2021, ay if atong tan-awon diri sa amortization table, naatay 445,382. So next is requirement number 3. So ang requirement number 3 is carrying value of the serial bonds payable at December 31, 2021. So makita na nato diri sa amortization table kung pilang atong carrying value sa serial bonds payable at December 31, 2021. So natay carrying value nga 3,756,902. So, gipakita diri sa book ang entries to record transactions in 2021. To record the issuance of bonds on January 1, 2021, so natay cash. So, natay cash na madawat nga 3,920,000. So, sa pag-issue sa bonds payable, na naman kay madawat nga cash nga 3,920,000 kining sa proceeds from issuance of bonds payable with warrants. And then, natay discounts on bonds payable nga makuha nato if atong i-minus ang 4 million sa atong fair value of bonds without warrants or sa carrying value pagka January 1, 2021, which is 3,711,520. Ang equally na ang difference is 288,480. So, muna discounts nato sa bonds payable. And then, mag-credit ta og bonds payable nga 4 million. And then, credit pod share warrants outstanding nga 208,480. So, mo ni sadya ang amount allocated to warrants. So, next is to record the interest payment on December 31, 2021. So, ang atong entry pod sa interest expense is debit interest expense 400,000 and cash 400,000. So, ato ba dyan is dyang nakuha sa 4 million times 10%. Then last is the record premium amortization on December 31, 2021. So we have to debit interest expense 45,382 and credit discount on bonds payable 45,382. Kay mo man ni siya discount amortization pagka December 31, 2021. If atong tan-awon sa amortization table. So, sa financial statement presentation during 2021, so sa statement of financial position sa non-current liability section, natay bonds payable nga 3,756,902 which is mo ni siya ang carrying value sa December 31, 2021 and share premium warrants outstanding nga 208,480. And then sa statement of comprehensive income, ang mabutang na dito is interest expense nga 445,382 pesos. And then sa notes to financial statements is atong gipakita dire ang net carrying amount sa kining bonds payable. So ang bonds payable nga 4 million atos dyang lesson sa discount sa bonds payable 243,098. So inikuha ni mo nani ang 3,756,902 nga carrying amount sa December 31, 2021 is ato sa dyang gimaynusan sa 208,480 nga share warrants outstanding. So, mo na siya ang discount sa bonds payable which is 243,098. So, inig-minus na to sa bonds payable sa discount on bonds payable na nalamtay net carrying amount nga 3,756,902. So, next is requirement number 4. So, net effect kono to equity assuming 60% of warrants were exercised. So, ang atong entry is mag-debit ka og cash, mag-debit pud ka og share warrants outstanding, and then credit common stock and share premium. So, para makuha na to ang cash, 4,000 is ato sa dyang timesan og 60% kay ingon man diri nga assuming 60% of warrants were exercised times 20 shares kay diba sa problem is ang bondholder kuno is ni purchase og 20 shares of common stock at 55 per share. So, ang 4,000 is ato dyang timesan sa 60% plus 20 shares times 55 pesos is equal to 2,640,000 pesos. So, mo ni siya ang cash na madawat if nasa jay 60% of warrants were exercised. Then, ang atong share warrants outstanding is makuha na to sa 208,480 pesos nga katong share warrants outstanding times 60% nga katong na-exercise na nga warrant. So, ma-equal na siya og 125,088. So, 125,088. So, ang formula pod para makuha na to ang common stock is ang 4,000 pesos nga gi-issue nga bonds payable is ato sudyang i-times sa 60% nga na-exercise na nga warrants times 20 ka shares kay mo man ni ang gi-purchase sa bondholder times 50 pesos which is mo ni siya ang par sa katong 20 shares of common stock. So, bali na siya 50 pesos. So, 4,000 times 60% times 20 times 50 pesos is maikwa sa siya og 2,400,000. And para makuha na to ang share premium is mo gamit ta og balancing figure. So, it means ang cash and ang share warrants outstanding is atong i-add. Like, tanang debit atong i-add, then minusan na to sa credit. So, cash plus share warrants outstanding nga 2,640,000 and 125,088 atos diyang minusan sa common stock nga 2,400,000. So, natay share premium nga 365,088. Diba natay increase in share premium nga 365,088 ato si Jang minusan sa decrease in share warrants outstanding which is kining naa sa debit side nga 125,088. So natay net increase in share premium nga 240,000 pesos. So last requirement is net effect to equity assuming the other 40% of warrants expired. So if ang warrants nga gi-issue is na-expire na, so ang net effect ani nga to sa equity would be 0. So, ang balance sa share warrants outstanding will be reclassified as part sa general share premium. So, manis siya ang entry. Debit ka share warrants outstanding and then credit ka share premium. So, share warrants outstanding, makuha na to siya sa 208,480 pesos nga atong share warrants outstanding pagka January. Ato diyang times sa 40% nga na-expire ng warrants. So, may ikwa sa og 83,392 pesos. Convertible bonds. So, when dealing with convertible bonds, which grant the holder the option to convert the bonds into equity securities of the issuer, it is crucial to recognize the separate components of the financial instrument. This involves identifying the component that creates a financial liability for the entity, which is the bond, and the component that grants the option to convert it into an equity instrument, the conversion option. The total proceeds from the issuance should be allocated to both the bonds and the conversion option using the residual approach, where the equity component is determined by subtracting the fair value of the liability component from the total proceeds. This ensures that the dual nature of the instrument is properly accounted for. Additionally, the accounting treatment for transactions involving the conversion option must be carefully considered to accurately reflect the financial impact of conversions on the entity's financial statements. So, conversion of convertible bonds. So, according to PAS 32, when a convertible instrument is converted, the entity derecognizes the liability component and recognizes it as equity. The original equity component remains unchanged, although it may be transferred within different equity line items. It is important to note that the conversion is not accounted for as a debt for equity swap as per the requirements of IFRIC 19. There are two types of conversion for bonds. We have the regular conversion and induced conversion. Ang regular conversion means where no gain or loss is recognized, while ang induced conversion, a loss may be recognized but not a gain. This distinction ensures appropriate accounting treatment for different types of conversions and maintains the integrity of financial reporting. So, unsa day po ning induced conversion? So, when a debtor enterprise induces early conversion of convertible debt, it must recognize an expense equal to the fair value of all securities and other consideration transfer that exceeds the fair value of securities issuable under the original conversion terms. This expense is recognized at the date the offer is accepted by the convertible debt holder, typically when the debt holder converts the convertible debt into equity securities or agrees to do so. If the terms of the convertible instrument are amended to induce early conversion, any difference in the fair value of the consideration received under the revised terms compared to the original terms is recognized as a loss in profit or loss. This ensures proper accounting treatment for inducements and maintains transparency in financial reporting. In cases where there would be amendments of terms to induce conversion, additional loss should be recognized in the profit or loss for the period. So this shall be computed as follows. So mo ni siya ang formula. Ang fair value of shares converted at sadyang lesson sa fair value of shares under original conversion, ang total ani is gitawag og debt conversion expense or loss on induced conversion. And then, para makuha po ang fair value of shares converted, mo po ni siya ang formula. Face amount of debt securities converted ato siya i-divide by new conversion price, mo ni siya ang number of shares issued upon conversion, and then ato siya i-multiply by fair value of shares on a conversion date, and mo na siya ato nang makuha ang fair value of shares converted. And then, para pod makuha ang fair value of shares under original conversion, atong kuhaon ang face amount of debt securities converted, atong i-divide by old conversion price, and then number of shares issued under original conversion, and then ato siya i-multiply sa fair value of shares on the conversion date, and ato na makuha ang fair value of shares under original conversion. So, atong i-take note nga, ang new conversion price is kinahanglan sidyang lower sa old conversion price so that ang mga bondholder will be encouraged or induced to convert their bonds. So, this will result to a loss due to induced conversion but not gain on induced conversion. Conversion of non-convertible bonds. So, when a debtor converts non-convertible bonds into equity instruments, the transaction falls under the scope of IFRIC 19. In such cases, the debtor should measure the equity instruments issued to the creditor at fair value unless fair value cannot be reliably determined. If fair value is not determinable, the equity instruments are measured at the fair value of the liability extinguished. The debtor then recognizes in the profit and loss statement the difference between the carrying amount of the financial liability or part extinguished and the measurement of the equity instruments issued. This ensures proper accounting treatment for debt for equity swaps and maintains transparency in financial reporting. So let's analyze illustration na pod for conversion of convertible and non-convertible bonds. On January 1, 2021, Bohol Company converted its 5,001 pesos face value 12% bonds payable with a carrying amount of 5,248,634 for 100,000 ordinary shares with a par value of 50 pesos. The fair value of the bonds on the date of retirement is 5,400,000 pesos. So, ang requirement is mag-prepare ta og mga necessary entries on the date of conversion. So, case number 1. Assume that the bonds are convertible bonds and the share premium from conversion option was 180,000 pesos. So, before mo atong i-analyze ang problem is ato sang i-discuss ang journal entry di ay sa convertible bonds. So, ang journal entry is mag-credit mag-debit rather og bonds payable at face amount, loss on retirement of bonds if applicable siya, and then premium on bonds payable if applicable pod, share premium conversion privilege, and retained earnings which makuha nato atong gamitan og balancing figure. And then mag-credit ka og cash, the retirement price, and then discount on bonds payable if applicable, and then gain on retirement of bonds if applicable pod, and then share premium excess over par ato po diyang i-balancing figure. So, let's answer na the case number 1. So, ato ko nung i-assume nga ang bonds are convertible bonds. And the share premium from conversion option was 180,000 pesos. So, mag-debit og bonds payable. So, makuha na to ang bonds payable kay 'di ba ang journal entry is bonds payable at face amount. So nikuha na to sa bonds payable ang 5,000 nga convertible bonds is ato sa diyang i-times sa 1,000 pesos nga face value. So 5,000 times 1,000 is equal to 5 million. And then mag-debit pug ka og share premium conversion option which is 180,000 pesos. And then also mag-debit ka og premium on bonds payable. So para makuha nato ang premium on bonds payable, na atay ang atong carrying amount is ato sidyang i-minus sa atong bonds payable or ang face amount sa bonds payable. So, carrying amount nga 5,248,634 ato sidyang minusan sa 5 million nga face amount sa bonds payable. So, ang atong premium on bonds payable is equal to 248,634. And then, credit ka og ordinary shares. So, inikuha na to sa ordinary shares, di ba na naka-state dere nga converted, it's 1,000 pesos face value, 12% bonds payable with a carrying amount of 5,248,634 pesos for 100,000 ordinary shares. So, bali ijang i-convert ang bonds into 100,000 ordinary shares with a par value of 50. So, para makuha na to ang ordinary shares, atong i-times ang 100,000 sa 50 pesos par value. So, 100,000 times 50 is equal to 5 million. And then, mag-credit na pud ta og share premium. So, para makuha na to ang share premium, atong i-plus ang carrying amount nga 5,248,634 sa conversion option nga 180,000 and then minusan na to og 5 million and ma-equal siya og 428,634. So, makaingon mo nga, nganong na ay share premium. So, na ay share premium kay ang sum sa carrying amount and the conversion privilege is greater than siya sa par or stated value. So, ang difference man nila is ato sidyang i-recognize as an increase in share premium. So, diba, as you can see, dere, ang carrying amount nga 5,248,634 plus sa kining conversion option 180,000 is mas dako siya sa ordinary shares nga 5 million. So, mo nang natay increase nga share premium nga 428,634. So, wa siya gain dere, wa pa siya loss on regular conversion of convertible bonds. So, case number 2. Ato na pong i-assume dere sa case number 2 nga ang bonds are non-convertible and the conversion is a result of debt for equity swap. So, there is a conversion of non-convertible bonds is nanatay ma-record na profit or loss. A difference between sa carrying amount of the financial liability or part extinguished and the measurement of the equity instruments issued. Okay, so we have to debit bonds payable na pod 5 million. Diba? 5,000 times 1,000 is equal to 5 million. Mamuni atong bonds payable at face amount 5 million. And then, we also have to debit loss on settlement of liability. Kay, lagi, as I've said, sa conversion of non-convertible bonds is nanata diri ma-recognize nga profit or loss sa difference between sa carrying amount sa financial liability, part nga na-extinguish, and sa measurement sa equity instrument nga issue. So, para makuha na to ang loss on settlement of liability diri, ang formula ay nani fair value sa liability ato sadyang lesson sa carrying amount sa bonds payable and then mo na sadya ang loss sa settlement sa liability. So, diri ang problem is natay fair value sa liability nga 5,400,000. Kaya diba naka-state dira sa problem nga the fair value of the bonds on the date of retirement is 5,400,000. So, ato siya pong minusan sa carrying amount sa bonds payable nga 5,248,634. So, natay loss sa settlement of liability nga 151,366. And then, mag-debit po ta og premium on bonds payable nga 248,634. And then, mag-credit na po tawag ordinary shares nga 5 million and then share premium nga 400,000. So, this naman po ding share premium. So, para makuha na to ang share premium, ang atong formula na ni is ang fair value sa liability ato sidyang minusan sa total par value of the shares issued. So, di ba natay fair value sa liability nga 5,400,000 and then ato sidyang minusan sa total par value of the shares issued nga 5 million rather. So, 5,400,000 minus 5 million is equal to 400,000 pesos. So, muna dyan atong share premium. So, take note ha nga if ang if ang problem gani is silent, ang bonds payable ana are assumed to be non-convertible. So, ito na pong i-analyze ang illustration for induced conversion. So, on January 1, 2020, si Buko issued 1,200,000 pesos, 8% convertible bonds due after 4 years. The bonds were sold for 1,123,910 pesos and are convertible into 10 pesos per ordinary shares at a conversion price of 25 pesos per share. On December 31, 2021, si Buko, in an effort to induce conversion of the bonds into ordinary share, reduced the conversion price to 20 pesos per share for bondholders that converted within 40 days. On this date, the fair value of the bonds is 1,500,000 pesos and the bonds have a carrying amount of 1,158,332 pesos. All the bondholders accepted the offer on December 31, 2021. On the date of conversion, the fair value of the Sibuco's ordinary share is 28 pesos per share. So, ang requirement is mag-prepare ta og necessary journal entries in 2021. So, di ba nakagipakita ganina nga formula inikuha sa mga amounts nga necessary for the journal entry sa induced conversion. Ang first natong computon is ang fair value of shares converted. So, para makuha na to ang fair value of shares converted, ang face amount sa debt securities nga converted is ato sidyang i-divide sa new conversion price. So, naata diri nga gi-issue nga convertible bonds nga 1,200,000 pesos. So, muna siya ang face amount sa debt securities nga gi-convert. And then, ato siya i-divide sa new conversion price which is 20 pesos diri na sa December 31, 2021. So, 20 pesos. So, 1,200,000 pesos divided by 20 is equal to 60,000. So, muna siya ang number of shares issued upon conversion. And then, ang kining 60,000 is ato sidyang i-multiply sa fair value of shares on the conversion date. So, 60,000 times 28. Kay, gistate dere sa problem nga, ang fair value kuno sa Sibuco on the date of conversion, ang ijang fair value sa ordinary share is 28 pesos per share. So, ang 60,000 atong i-multiply sa 28,000 is equal to 1,680,000 pesos. So, mo ni sa atong fair value of shares converted. And the next atong kuhaon is ang fair value of shares under sa original nga conversion. So, para makuha ni nato ang face amount sa debt securities nga gi-convert is ato sudyang i-divide sa old conversion price. Instead sa new conversion price, ang ato sudyang i-divide sa old conversion price. So ang 1,200,000 pesos ato sudyang i-divide sa 25 because mo ni sudya ang conversion price sa January 1, 2020. So 1,200,000 pesos times 25 is equal to 48,000. Mo ni siya ang number of shares issued under original conversion. And then, ang kining 48,000 po, ato na po siyang i-multiply sa fair value of shares on the conversion date, which is 28. So, 48,000 times 28 is equal to 1,344,000 pesos. And mo ni siya ang fair value of shares under original conversion. Then, ang atong sunod, ang atong last nga kuhaon is ang debt conversion expense or loss on induced conversion. So, ang fair value of shares converted, ato sa diyang lesson sa fair value of shares under original conversion. So, fair value of shares converted, 1,680,000, mo niyang katong ato bitaw diyang i-divide sa new conversion price. So, 1,680,000 minus sa fair value of shares under original conversion nga 1,344,000 pesos. So, mo equal siya og 336,000 pesos. So, mo ni siya ang loss on induced conversion. So, ang journal entries ani is we have to debit bonds payable at face amount nga 1,200,000 pesos. Debit pud ka debt conversion expense or loss on induced conversion nga 336,000 pesos. We have to credit discount on bonds payable. So, inigkuha na to sa discount on bonds payable is ang 1.2 million ato sidyang minusan sa 158,332. Kay natay discounts on bonds payable kay mas gamay ang carrying amount kaysa sa face amount sa bonds payable. That's why we have to credit discount on bonds payable. So 1.2 million pesos minus 1,158,332 nga carrying amount is equal to 41,668 pesos. And then we also have to credit ordinary shares. So nikuha na to sa ordinary shares. Diba natay number of shares issued upon conversion? Diri sa inikuha na to sa fair value of shares converted, nata diri 60,000. So ato sidyang timesan sa 10 pesos kay mao man ni sidya ang par ordinary share. Convertible into kuno 10 pesos per ordinary shares. So 60,000 times 10 pesos is equal to 600,000. And we have also to credit share premium. And then inikuha natin nga ni is magbalancing figure na punta. So add ta ng debit, minusan pud nimo sa sum sa credit side, and then man siya ang imong share premium. 1.2 million plus 336,000 minus 41,660 pesos minus 600,000 is equal to 894,332. So, take note nga ang cash is not debited equal to the conversion price tungod kay ang market conversion price merely indicates the ratio of shares to be issued upon conversion of the bonds. So, bonds payable to be redeemed contractually at a premium or discount. So, when bonds payable are to be redeemed at a premium or discount, ang liability must be accredited over time to ensure that the carrying amount sa liability matches the redemption price at the redemption date. So if ang bonds are redeemed at a premium, the accretion of the premium is treated as interest expense and imo na silang i-add adto sa accrued dividends for the period in the profit or loss statement. Conversely, if the bonds are redeemed at a discount, the accretion of the discount is deducted from the interest expense for that period. This accounting treatment ensures that the redemption premium or discount is properly reflected in the financial statements over the life of the bonds. So let's analyze na pod illustration about issuance of bonds with redemption price. So Quezon Company issued 20,000 unsecured 10 pesos 12% bonds on January 1, 2021 at a discount of 4% to be redeemed on December 31, 2023 at a premium of 5%. These debentures were issued at an effective interest rate of 19.48%. Ang requirement is, nasa ka requirement. First is compute for the present value of the financial liability and prepare the amortization table. And ang ikaduha is mag-prepare ta og mga journal entries sa 2021, 2022, and 2023. So, there is a requirement number 1 is magamit na pata og PV of 1 and PV of OA1. So, ato sang computon una ang present value of principal including premium on the redemption date. So, di ba natay gi-issue nga 20,000 unsecured nga bonds pagka January 1, 2021 at 10 pesos. So, 20,000 times 10 pesos is equal to 200,000. So, ato sudyang timesan sa 1 plus ang iyang premium nga 5%, kay diba diri including premium on the redemption date. So 1 plus 5% times na pod nato sa PV of 1 nga 0.6542. So ang atong PV of 1 is 1 over 1 plus 15.1948% raised to 3 kay 3 years man sadya kay from January 1, 2021 to 2023. So 21, 22 and then 23. So raised to 3. So ato makuha ning 0.6542. So ang 200,000 times 1 plus 5% times 0.6542 is equal to 137,379 pesos. So, muna siya ang present value sa principal including premium. And then, ato po siyang add sa present value of interest. So, ang 20,000, ato na po siyang i-times sa 10 times 12% kay mo man ang interest sa bonds pagka January 1, 2021. And then, times sa makuha na to sa PV of OA1 which is 1 minus 0.6542 over 15.1948%. So, ang makuha na to nga present value of interest is equal to 54,600 21. So atong i-add ang present value sa principal including premium and then present value of interest. So 137,379 plus 54,621. So we have present value of 192,000 pesos. So, di ba, naapoy gi-require dere sa requirement number 1 nga mag-prepare ta og amortization table. So, mo po ni ang amortization table. So, ang interest payment sa kada year is makuha na to siya. Inig atong i-multiply ang 20,000 times 10 times 12% is equal to 24,000. So, muna siya ang interest payment. So, natay present value nga 192,000 and then ato siya ang i-times sa 15.1948%, natay interest expense sa December 31, 2021 nga 29,174. So para makuha na to ang amortization, we have to subtract interest payment og ang interest expense. So ilang difference is 5,174, and then para makuha na pud nato ang present value sa December 31, 2021, atong i-add ang present value sa January og ang amortization sa December 31, 2021. So 192,000 times plus rather 5,174 is equal to 197,174. So inanara ang process, so on and so forth. So ang amortization is kinahanglan si Jag ma-allocate pro rata to the discount and premium using this ratio. So nasa siya gi-provide dara. So sa discount is nasa siya 10 pesos times 20,000 sa katong bonds net times 4% kay na may gibutang dire nga at a discount of 4% nga ma-redeem ato sa December 31, 2023. So nasa siya discount nga 8,000 rather. So sa premium pod is 10 pesos times 20,000 times 5% kay nasa siya 5% nga premium. So nasa siya 10,000 premium. So ato siyang i-add nasa siya 18,000. So para makuha na to ang ratio dere sa discount is di ba 8,000 and then nasa siya total nga 18,000. So 8 over 18 or 18. So para na siya madali kay instead of mag 8,000 ka divide by 18,000 para makuha nimo ang kining 0.4444 is dali na naman siya 8 divide by 18 na lang largo, and then tripod sa premium is 10 over 18 which is ang ratio is equal to 18 over 18. Ang requirement number 2 is mag-prepare ta og mga necessary journal entries sa 2021, 2022 and 2023. So, the journal entries are sa January 1, 2021 is natay cash nga 192,000. So, kay natay 20,000 nga katuptang gi-issue nga bonds at kanang 10 pesos times 1 minus 4% kay nalagi kay discount nga 4%. So 20,000 times 10 pesos times 1 minus 4% is equal to 192 pesos. So mo ni mong madawat nga cash. And then nakay discounts on bonds payable nga 8,000. Kuha nimo ang discount on bonds nga 8,000 by 20,000 times 10 kay mo man ang bonds payable no, so 200,000 times 8% kay as you can see diri as a ratio nimo diri sa amortization table dapat diri sa ubos amortization table rather is na kay discount nga 8, so na kay 8% over sa 18%, so mo nang imo sa jang gitimesan og 8%, so mo nang 8,000. Then sa bonds payable imo rang i-times ang 20,000 sa 10 kay at 10 pesos man na gini dyan na gi-issue pagka January 1, 2021. So mo nang 200,000. So ang entry sa December 31, 2021 is nakay interest expense nga 29,174. Imo na sa tan-awon diri sa amortization table. And then nakay credit nga discount on bonds payable nga 2,300. So makuha na nimo siya by multiplying ang amortization nimo pagka December nga 5,174,000 times 44.44% rather. Mo ni siya ang imo pong ratio diri sa pro rata sa discount and premium sa diri na sa ubos sa amortization table. So mo na inikuha sa discount on bonds payable na kay 2,300. And then credit also premiums on redemption of bonds nga 2,874. So more lagi hapon na sa nga process, ang imo lang gilahi is ang ilang percent, kay ang percent pa sa premium is 55.56%. And then credit ka cash nga 24,000. So nakay cash dire, naka-credit ka cash dire nga 24,000 because sa namalagi sa interest payment nga 24,000. So December 31, 2022, you have to debit interest expense na pod nga 29,960. And then same ra siya sa entry sa December 31, 2021. So na discounts on bonds payable, premium on redemption of bonds, and then cash, as well as there is sa December 31, 2023, same ra og process, and then same ra pod og mga accounts. So December 31, 2023, ang imong bonds payable na nalamang kay carrying amount nga 200,000, and then premium on redemption bonds nga 10,000, and then cash nga 210,000. So ang financial statement presentation sa 2021, so there is a financial position, non-current liability section, na kay bonds payable nga 200,000, na kay discount sa bonds payable nga 5,700, gikan ni siya sa 8,000 nga discount pagka January 2021, and then minusan nimo og 2,300 kay naka-discount on bonds payable dere pagka December 31, 2021. So 8,000 minus 2,300 na naman kay 5,700,000. And then mag-add ka og premium on redemption of bonds nga 2,874. So ang total diri is 197,000 rather 174 pesos. And then there is a statement of comprehensive income sa 2021 is na kay interest expense nga 29,174. So the last topic for today is about redeemable preference shares to be redeemed contractually at a premium or discount. So when redeemable preference shares are to be redeemed at a premium or discount, ang liability nga na-associate inana must be adjusted over time to ensure nga ang carrying amount sa liability matches the redemption price at the redemption date. So if ang preference shares are redeemed at a premium, so the accretion of the premium is treated as interest expense and added to the accrued dividends for the period in the profit or loss statement. Conversely, if ang preference shares pod is redeemed siya at a discount, so ang accretion sa discount is deducted from the interest expense for that period. So this accounting treatment ensures that the redemption premium or discount is properly reflected sa financial statements over the life of the preference shares. So illustration na pod. So Aguinaldo Limited issued 15,010 pesos per 10% redeemable preference shares on January 1, 2021. The shares are subject to compulsory redemption by the company on December 31, 2023 at a premium of 0.20 pesos per share. The effective interest rate on the date of issuance is 15.7203%. On December 31, 2023, the directors resolved to redeem the preference shares at a premium of 0.20 pesos per share. This was in accordance with the terms of the original issue. So, ang requirement niya is compute for the present values of financial liability and mag-prepare na pod og amortization table and mag-prepare og mga journal entries sa 2021 and 2022. So as always, magamit ta pud ta diri og PV of 1 and PV of OA1. So present value sa principal including premium on the redemption date is makuha na to siya by multiplying 10 pesos rather times 15,000 kay nag-issue siya og 15,000 at 10 pesos par. And then times na to siya sa 1 plus 0.20 kay nasa siya premium nga 0.20 pesos per share. Times sa atong makuha nga PV of 1 nga 0.6453. So natay present value of principal including premium nga 116,157 pesos. And then atong adan sa present value of interest nga makuha na to siya if atong i-multiply ang 15,000 times 10 times 10% kay 10% ba dire no nag-issue og 15,000 10 pesos per 10% redeemable preference shares. So times 10% times makuha na to siya sa PV of OA1 nga 2.2649. So natay present value of interest nga 33,843. So natay total nga present value nga 150,000 pesos. So ang amortization is mo ni siya. So natay present value nga 150,000. So, natay interest payment nga 15,000. This is because 15,000 times 10% times 10%. So, ani para makuha na po nato ang interest expense, ang atong i-times ang 150,000 nga percent value sa 15.7203% nga effective interest rate sa date of issue 1. So, natay 23,580. And then, ato na pong i-minus ang interest payment sa interest expense para makuha na to ang amortization. And then, present value plus amortization minus ang present value sa December 31, 2021. So, marag hapon ang process. So, requirement number 2 are journal entries. So, sa January 1, 2021, nakay cash nga 150,000 kay 15,000 times 10 pesos. And then nakay preference shares nga 150,000. And then December 31, 2021, nakay interest expense nga 23,580 and premium on redemption of preference shares nga 8,580 pesos. Diri na nimo siya makuha sa amortization. And then nakay cash nga 15,000 kay interest payment. And then, marigihapon same process sa December 31, 2022 nga journal entries and sa December 31, 2023. So, December 31, 2022, nakay preference shares nga 150,000, nakay premium on redemption of preference shares nga 30,000, and then nakay cash nga 180,000. So that would be all for my part. Thank you for listening and have a good day.
Good day everyone, I am Kyla Jean Liorna and I am going to discuss the notes payable, loans payable, and debt restructuring. First, let us discuss the notes payable. So notes payable, it is a promissory note in which one party, called the maker or issuer, promises in writing to pay a sum certain money to the other party called the payee, either on demand of the latter or at a fixed or determinable future time. It is recognized when the entity becomes a party to the contract or when the transfer of resources transpired. It is presented in the liabilities section in the statement of financial position and classified as to either current or non-current depending on the expected settlement date. The net carrying value is to be reported on the face of the statement of financial position as part of the liabilities section. Net carrying value is determined as follows. Face amount less discount on notes payable is equals to net carrying value. Notes payable shall be initially measured at fair value minus transaction cost. However, PFRSS allows short-term notes payable to be measured at face amount since the difference between the face amount and its fair value is considered to be immaterial. Furthermore, in the absence of fair value, the notes shall be measured at discounted or present value. The following diagram shows the basis of measuring the long-term notes payables, discounted or present value on the date of initial recognition. So when the notes payable is interest-bearing liabilities, nominal interest rate approximates the prevailing market rate, it is measured at face amount, while the interest-bearing liabilities nominal interest rate is substantially different with market rate, it is measured at present value of principal and interest payments. Non-interest bearing liabilities issued solely for cash is measured at present value equal to cash. Non-interest bearing liabilities issued for non-cash assets is measured at present value equal to either of the following in order of priority. First, we have the cash price equivalent, and second, we have the present value of principal payments. It is to note that any difference between the face amount and measurement basis is debited to discount on notes payable. Notes payable are subsequently measured at amortized cost using the effective interest method of amortization. So to expand our understanding, we have here the first illustration, the issuance of interest-bearing note using lump sum. So on January 1, 2021, Aklan Company acquired a machine from Antique Company. In lieu of cash payment, Aklan gave Antique a 3-year 600,000 pesos 3% note payable. Principal is due on December 31, 2023, but interest rate for this type of note is 10%. Requirement: compute for the carrying amount of the note payable on December 31, 2021. So in the given data, no information is available to measure the note's fair value. Thus, the note shall be measured at discounted or present value. So the note shall be initially recognized on January 1, 2021 at present value of principal and interest payment. So present value of principal, we have here 600,000 times the rate of 0.7513, 450,780, and present value of interest payments 600,000 times 3% times the interest of 2.4869. We have here 44,764. So the present value of notes payable is 495,544. So to arrive the carrying amount, it will be measured at amortized cost. So the following table shows the amortization table. We have here the present value 495,544 added to discount amortization of 31,554. So we have the carrying amount on December 31, 2021 of 527.99. So second illustration, the issuance of non-interest bearing note with one-time payment of the principal. On January 1, 2021, Capiz Company acquired a machine from Guimaras Company. In lieu of cash payment, Capiz gave Guimaras a 3-year 600,000 non-interest bearing note payable due on December 31, 2023. The prevailing rate of the interest for this type of note is 10%. Required: compute the amount that should be recorded as a net liability on December 31, 2021. So the present value of the principal, to compute 600,000 times the rate of 0.7513, we have 450,780. It will be added to the interest expense of 45,078. So we have the amount to be reported on December 31, 2021 as net liability is 495,858. Third illustration, we have the issuance of non-interest bearing note with uniform payment of the principal. On January 1, 2021, Iloilo Company acquired a machine from Negros Company. In lieu of cash payment, Iloilo gave Negros a 3-year 600,000 non-interest bearing note payable. Principal is due on equal payments every December 31, beginning on December 31, 2021. Required: compute the amount that should be recorded as a net liability on December 31, 2021. So we have here the solution. Present value of the principal computed 200,000 times the rate of 2.4869. We have 497,380. So 200,000 came from the 600,000 3-year note payable divided by 3. So we have the 200,000 yearly payment. So ang present value of the principal, 497,380, will be deducted to discount amortization of 150 to 162. So the amount to be reported on December 31, 2021 as a net liability is 347,180. Fourth illustration, we have the non-interest bearing note with cash price equivalents. So on January 1, 2021, Oriental Company acquired inventory with a list price of 800,000 and a cash price of 497,380 by issuing a 3-year 600,000 pesos non-interest-bearing note payable. Principal is due in equal payments every December 31, beginning on December 31, 2021. The effective rate of interest interpolated for the cash price is 10%. So required, determine the following. First, the carrying amount of the note on initial recognition, and second, the carrying amount of the note for the year ended December 31, 2021. So requirement 1, we have here the solution. The carrying amount of the note on initial recognition is equal to cash price of 497,380. While to team to come up with the carrying amount of the note for the year ended December 31, 2021, we will use the amortization table. We have here the present value of 497,380 deducted to the discount amortization of 150 to 162. So the carrying amount on December 31, 2021 is 347,180. So for our next topic, we have here the loans payable. Loans payable is a financial liabilities other than short-term trade payables on normal credit terms. It is similar to notes payable except that this borrowing is normally obtained from financial or lending institution. It is recognized when the entity becomes a party to the contract or when transfer of resources transpired. It is presented in the liability section in the statement of financial position and classified as to either current or non-current depending on the expected settlement date. And it is initially measured at fair value minus transaction cost and subsequently measured at amortized cost using the effective interest method of amortization. So to illustrate, on January 1, 2021, Occidental Company borrowed 10% 2,500,000 5-year loan from National Bank. Interests are payable annually starting December 31, 2021. National charges 5% non-refundable loan origination fee representing service fee. So required, first we have the carrying amount of the loan payable on January 1, 2021. Second, we have the carrying amount of the loan payable on December 31, 2021. And last, the total interest expense for the year ended December 31, 2023. So we have here the first requirement. Carrying amount of the loan payable on January 1, 2021. We have here the face amount of 2,500,000 less the loan origination fee of 5% of 2,500,000 equates to 125,000. So we have the initial carrying amount of loans payable of 2,375,000. So the second requirement, the carrying amount of the loan payable on December 31, 2021. We have the present value at 12%. So we have here the present value of principal, the 2,500,000 times the rate of 0.5674. We have 1,418,500 and the present value of interest 2 million times 10% times 3%. We have 901,200. So the total present value at December 31, 2021 is 2,319,700. Using the amortization table, we have the carrying amount at December 31, 2021 of 2,395,432. So for the third requirement, we have the total interest expense for the year ended December 31, 2023. We will use the amortization table using the 11.39%. So as you can see, we have the carrying value at the beginning In January 1, 2021, we have 2,375,000, less than the a discount amortization of 20,432. So the interest expense for the year ended December 31, 2023 is 275,350. So for the last topic, we have the debt restructuring. It is a process that allows entities facing cash flow problems and financial distress to reduce and renegotiate its delinquent debts in order to improve or restore liquidity and rehabilitate so that it can continue its operations. It aims to avoid default on existing debt, minimizes unfavorable consequences of non-compliance with debt agreements, or take advantage of lower interest rate. Debt restructuring could either be a legal requirement or mutual agreement between a financially troubled debtor and its creditors to reorganize its liabilities as a more feasible alternative to foreclosure or liquidation. The categories of debt restructuring we have here: debt forgiveness. It is a liability may be extinguished through forgiveness of the debt by the creditor. The carrying amount of liability forgiven is simply recognized as gain on extinguishment of debt by the debtor in profit or loss. So to illustrate, we have Negros Company provided the following balances on December 31, 2021. We have the note payable of 1 million and accrued interest payable of 100,000. On December 31, 2021, the creditor forgave the accrued interest and 40% of the notes. Required: provide the journal entry for 2021 in the books of Negros. So to record the forgiveness of debt, we have the debit notes payable 40% of 1 million, so 400,000. Debit accrued interest payable of 100,000, and credit on gain on extinguishment of debt 500,000. The second category of debt restructuring is the asset swap. It is the liability by delivery of non-cash asset by the debtor. Gain or loss and extinguishment of debt to be included in profit or loss for the period is determined as follow: carrying amount of asset give less carrying amount of liability extinguished is equal to the loss or gain on extinguishment of debt. To illustrate, Sikohar Incorporated provided the following balances on December 31, 2021: the notes payable of 1,600,000 and accrued interest payable of 200,000. On December 31, 2021, the entity transferred to the creditor land recorded at a cost of 1,500,000. As of this date, the land has a fair value of 2 million. Determine the amount of gain or loss to be recorded in the statement of comprehensive income. So we have here the solution. Carrying amount of land 1,500,000 less the carrying amount of liabilities extinguished. We have the notes payable of 1,600,000 and accrued interest payable of 200,000 will will be equal to 1,800,000. So the gain and extinguishment of debt is 300,000. The third category of debt restructuring is equity swap. The liability is extinguished through issuance of own equity securities by the debtor to the creditor. Gain or loss and extinguishment of debt is determined as follows: initial measurement of share capital less carrying amount of liability extinguished is equal to loss or gain on extinguishment. We have here the illustration. Lapu-Lapu Company showed the following data on December 31, 2021. Funds payable of 4,500,000 and accrued interest payable of 300,000. On December 31, 2021, the entity issued share capital with a total par value of 2 million. Both share capital issued and bonds payable are quoted in an active market at 4,400,000 and 4,700,000 respectively. Required: gain or loss to be recorded in the statement of comprehensive income and the amount credited to share premium from the extinguishment of the liability. So we have here the gain or loss to be recorded in the statement of comprehensive income, the initial measurement of share capital issued of 4,400,000 less the carrying amount of liabilities extinguished, bonds payable of 4,500,000 and accrued interest payable of 300,000. We have 4,800,000. So the gain on extinguishment of debt is 400,000. The amount credited to share premium from the extinguishment of liability is measured at initial measurement of share capital issued 4,400,000 less par value of share capital issued 2 million. So we came up with 2,400,000. The last category of debt restructuring is modification of terms. Modification of terms may involve one or combination of the following: the debt rescheduling or modification of maturity date, modification of interest or maturity value or both, and exchange of debt instruments with substantially different terms. So when we say substantial modification, the terms are substantially different if the discounted present value of the cash flows under the new terms, including any fees paid, not any fees received, and discounted using the original effective interest rate, is at least 10% different from the discounted present value of the remaining cash flows of the original financial liability. While non-substantial modification, the terms are considered non-substantial if the discounted present value of the cash flows under the new terms, including any fees paid net of any fees received and discounted using the original effective interest rate, is less than 10% different from the discounted present value of the remaining cash flows of the original financial liability. Costs or fees incurred during modification. If an exchange of debt instruments or modification of term is accounted for as an extinguishment, it is recognized as part of the gain or loss on the extinguishment, while if it is not accounted for as an extinguishment, it is recognized as adjusted to the carrying amount. The gain or loss on extinguishment, whether the modification is substantial or not, gain or loss is recognized in the profit and loss, and it will be computed as present value of the modified terms using the original effective interest rate less the carrying amount of liability, which equates to the loss or gain on extinguishment of debt. We have here the first illustration, the modification of terms substantially modified. Mandawi Company has an overdue note payable to National Bank of 8 million and recorded accrued interest of 840,000 based on 12% interest rate. As a result of a settlement on December 31, 2020, National Bank agreed to the following restructuring arrangement: reduced the principal obligation to 7 million, forgave the 840,000 accrued interest, extend the maturity date to December 31, 2022, and annual interest of 10% is to be paid on December 31, 2021 and 2022. Required: compute the gain or loss to be recorded in the statement of comprehensive income and prepare the necessary journal entries. So the solution to the first requirement, we have the fair value of the new liability, the present value of principal, 700 million times 0.7972, we have 5,580,400. Present value of interest, 7 million times 10% times 1.69. We have 1,183,070 less the carrying amount of liabilities extinguished, the original notes payable of 8 million and the accrued interest payable of 840,000. So 6,763,470 less 8,840,000. We have the gain on extinguishment of debt of 2,076,580. The to record the journal entries, we have debit notes payable 8 million, Debit accrued interest payable 840,000, debit discount on notes payable 236,530, and credit to notes payable the new amount 700 million, and the gain on extinguishment of debt profit or loss we have 2,076,530. The second illustration, the modification of terms not substantially modified. Lapu-Lapu Company has a note payable to National Bank of 8 million and the note bears interest of 12%. As a result of a settlement on December 31, 2020, National Bank agreed to the following restructuring arrangement. First, extended the maturity date to December 31, 2022, and the annual interest of 10% is to be paid on December 31, 2021 and 2022. Required: first, compute the gain or loss to be recorded in the statement of comprehensive income, and second, prepare the necessary journal entries. So for the requirement 1, the fair value of new liability, we have present value of principal 8 million times a rate of 0.7972. We have 6,377,600. We have the present value of interest 8 million times 10% times the rate of 1.69. We have 1,352,080, well, which equates to 7,729,680. Last, the carrying amount of liabilities extinguished, which is the notes payable of the original cost of 8 million. So 7,729,680 less the original cost of 8 million, we have the gain on extinguishment of debt of 270,320. So the necessary journal entries to record, we have debit discount on notes payable 270,320 and credit gain on extinguishment of debt in profit and loss of 270,320.